I'm Grant Walker. Welcome to Last Call for Wednesday, the 10th of June, and I'll be back with Heads Up Thursday morning, 10 a.m. To People News, former Secretary of the Council of Trade Unions Peter Conway has died in Wellington after a 12-month battle with a depressive illness. Mr Conway was a veteran of the unions, devoting himself to improving the lives of New Zealand's working class. Before his appointment as the economist and secretary of the CTU, Mr Conway served as the chair of Oxfam New Zealand and was on the board of New Zealand Trade and Enterprise. Among his many accomplishments, Mr Conway helped lead the protests against the changes to employment law, which would have seen workers losing their tea breaks. Mr Conway left the CTU late last year and was honoured by many people in the industry. CTU President Helen Kelly said upon news of Mr Conway's departure as secretary, "It has been a highlight of my career to work alongside Peter Conway. Peter has made a tremendous contribution to workers and their unions over almost 40 years, and I know he will continue to do great work for the people of New Zealand." He worked for a number of unions, including the Canterbury, Western, Nelson and Marlborough Clothing Trades Union, New Zealand Distribution Workers Federation, New Zealand Nurses Organisation, as well as the CTU. In 2000, Mr Conway came to the CTU as the Economist and Director of Policy, a role he held until his election in 2009 as CTU Secretary. Ms Kelly said Peter's contribution has been outstanding and has included providing a strong and credible alternative voice on New Zealand's economic strategy, which recognises that all Kiwis can and should benefit from a balanced approach to economic growth. To our dollar, the New Zealand dollar edged up ahead of the Reserve Bank's monetary policy statement tomorrow, with opinion divided over whether the benchmark interest will be cut or remain on hold. The Kiwi advanced to 71.31 US at 8 a.m. this morning. The TWI gained to 74.7. Traders are fine-tuning their positions ahead of the Reserve Bank's decision tomorrow. 6 of 16 economists expect Governor Graham Wheeler to reduce the official cash rate by 25 basis points to 3.25% amid low inflation, weak dairy prices, declining business and consumer confidence, and following additional measures to curb Auckland's bubbling housing market. Still others say the conditions have not yet been met to cut rates. Most are betting Mr Wheeler will emphasise his easing bias, which has helped weaken the Kiwi by 7.5% over the past 30 days, making it the worst performing major currency. Traders are currently placing a 40% chance on the Reserve Bank reducing rates tomorrow, down from a 54% chance on May 29, according to the overnight index swap curve. Rabobank's Foley expects the Kiwi to edge lower to 69 US cents over the next 6 to 9 months as the Reserve Bank cuts rates during the second half of this year and as the greenback advances as the Federal Reserve moves to hike rates in December. In New Zealand today, electronic card transaction data for May is scheduled for release, giving an indication of how second quarter growth is tracking. The local currency advanced to 92.78 Australian before a report on Australian consumer confidence and a speech by Reserve Bank of Australia Governor Glenn Stevens to the Economic Society of Australia in Brisbane. The Kiwi rose to 63.23 euro, advanced to 88.66 yen, and little changed at 46.35 British pence.
This is NBR Radio on Wednesday, June 10th. I'm Owen Poland. Well, the OECD has just released its biennial report on New Zealand's economy, and our political and economic editor, Rob Hosking, has been digesting the key features. Rob, what do you make of it?
Well, to some degree, it's same old, same old. The OECD does this, as you said, every 2 years. The new stuff in here is around the increased urgency around housing. And it's been interesting watching some of the political responses to this because it's very much like, that old joke about blindfolding people and then asking them to feel an elephant and tell you what creature they think it is, because some will say it's a snake and some will say it's a wall, depending on which bit they actually grab. It's already been suggested that the problem is that New Zealanders are piling too much money into housing, when in actual fact the OECD says quite explicitly that isn't the problem, because we don't have enough housing. So you can't actually say, given the population pressures, that we're under-investing in housing. The issue is that the new housing isn't happening quick enough, and the existing housing we have, too much of it is in the wrong places. So that kind of confirms the current government stance on the whole issue. It does give them a bit of a kick, I suppose, because it specifically targets the existing approach under the Resource Management Act. Now the government is still talking about doing something there, but they've had to back away from the original plan because they lost the Northern by-election and they don't have the numbers anymore, again, because basically Peter Dunn is holding out on this one. So the other thing, and this is related to it, that I found quite extraordinary was they really did put the boot into the Auckland Council pretty specifically in this report. That I found, I haven't seen that happen before. Usually they keep their criticisms reasonably general. But this really did sort of put the boot in and say, look, the metropolitan urban limits were a constraint for too long on supply. They're being expanded soon, but it's taken too damn long to get to this point.
The OECD's economist David Carey must have been well briefed by government ministers.
Well, he did actually work here some years ago. I had a long chat with him last night because he is in Paris. Most of, he did talk to ministers certainly, but pretty much everything in here is carefully footnoted. It's quite a well referenced report, and it refers to Productivity Commission report, Reserve Bank work, some of the Statistics Department figures, and it's very much aimed at, and I think there's some Motu stuff as well, and some of the work Arthur Grimes, who is basically, he's pretty much New Zealand's leading authority on housing and supply and related issues. So this is not just an apology for the current government. They're quite critical in some areas. Some other areas partly critical. They want to see more action on savings than we've seen from the government to encourage private savings. The other thing they urge for Auckland is some sort of congestion charging to help fund infrastructure. Now the government's ruled that out, and that's slightly embarrassing. The fact is the government's not going to do that because however rational it might be, it's just a vote loser.
So, just to sum up, Rob, what's the government going to make of this? Are they going to be fairly pleased with it?
I think they will. Look, it does endorse the broad economic direction, so they'll probably be quite pleased about that. They'll do what every government does with these things, which is, they'll pick out the bits they like and pass over the other bits with an embarrassed silence.
Okay, Rob, thanks. That's our political and economic editor, Rob Hosking.
NBR Radio with the Property Press. It's out now to show you around.
To Christchurch. Christchurch Mayor Leanne Dalzell has shortlisted her choice of city assets for sale, while the council's chief executive is unleashing a new wave of restructuring. Ms Dalzell has issued a positioning paper before the full council vote in a couple of weeks on the council's controversial long-term budget. Cash-strapped city leaders have been forced to consider the unthinkable for many Christchurch residents, sale of the Orion Powerlines Company, Airport and Littleton Port. But Ms Dalzell has highlighted the two most obvious city-owned subsidiaries for sale, which have so far escaped much public attention: property and infrastructure company Citycare and transport provider Red Bus. She's also questioned whether the city needs to own all properties it operates, including Lancaster Park and Arena Stadium. Ms Dalzell says, "I simply cannot see how car park buildings, a facilities management company that does catering, a bus company and a construction and infrastructure company, all of which operate in competitive markets, can possibly be regarded in the same light as natural monopoly infrastructure companies such as our Lines Company, Airport and Seaport." I believe, she says, my proposal strikes the right balance between the two resounding messages we've heard from residents, getting their proposed rates increases down and retaining public ownership and control of our core infrastructure assets, the port, the airport and Orion. She said, under my proposal, they remain strategic assets, and any sell-down of their shares to strategic partners that directly benefit the city will trigger a special consultative procedure. I would much rather have that debate at the time. Even so, her proposal includes hefty and arguably unsustainable rates increases. Instead of proposed rates increases of 33% over the next 4 years, Ms Dalzell proposes 29%. It remains to be seen if a grouping of left-leaning councillors will accept the plan. Many of those councillors who represent Eastern Christchurch have been strong proponents of increased amenity and infrastructure spending in the areas, but are also those who are most opposed to asset sales. Meanwhile, City Council Chief Executive Carleen Edwards has announced a new restructure of management to cut bureaucracy and make the organisation more nimble. The council employs more than 2,570 people. She says the council needs to be prepared to take over the functions of the Canterbury Earthquake Recovery Authority later in the year, or whenever the government hands over the reins and eliminates its dual bureaucratic role, which is generally accepted as holding back rebuilding of the central city. However, her purview does not extend to subsidiaries like V-Base or the Canterbury Development Corporation, which has been accused of duplicating work and services provided by the Ministry of Business, Innovation and Employment and business groups like the Canterbury Employers Chamber of Commerce. The council subsidiaries are supported by millions of dollars of ratepayer money annually. CDC enjoys $4.8 million of direct council annual funding and holds assets of $8.5 million, which includes investments in various technology startups. NBR rich-listed Diane Foreman's Emerald Group has sold its ice cream manufacturing subsidiary to a foreign collective for an undisclosed sum. Hong Kong-based Emerald Foods Group, HK, bought 100% of the shares in Foreman's Emerald Foods subsidiary on June 3, according to the company office filings, completing an acquisition that had been approved by the Overseas Investment Office in April. The acquisition needed OIO approval because Emerald Foods owns sensitive land in East Tamaki, Auckland. Foreign acquisitions need OIO approval where there is an interest in sensitive land or the transaction is more than $100 million. The value of the Emerald deal was withheld. The Hong Kong entity is 80% owned by Australian interests, with US investors holding almost 16% and other overseas people holding 4.3%, according to the OIO summary. It said the applicant intends to develop the business located on the land with particular regard to its exports to China. The office granted approval after being satisfied it would increase export receipts and attract additional investment for development. It also met the consequential benefits test, where the OIO believes it will provide additional New Zealand investment, sponsorship or community projects. Since taking ownership of Emerald Foods, the new parent has appointed 3 new directors, but Emerald Foods Managing Director Shane Lamont remained on the board. None of the directors, nor Ms. Foreman, who's travelling in Europe until August, responded to business desk inquiries. Foreman's Emerald Group bought the loss-making New Zealand Natural Ice Cream Company in 2004, wrapping it into Emerald Foods. Mr. Lamont joined the company as chief executive in 2006 and has since turned it into a profitable business. Emerald Foods' annual revenue was estimated to be between $40 to $60 million. To the dairy industry, increased milk production and a higher forecast payout to dairy farmers for the upcoming season should bolster the New Zealand economy by $1.8 billion, according to AgriHQ. The AgriHQ New Zealand milk production predictor forecasts growth of about 2.5% to 1930 million kilograms of milk solids for the 2015-16 season, following 3% growth in the 2014-15 season. The expectation for increased milk production comes as New Zealand dairy companies are forecasting higher payouts to farmers this year on the expectation global prices will pick up. Fonterra, the world's largest dairy exporter, expects to increase its payout for the 2015-16 season to $5.25 a kilogram of milk solids. Synlait expects to pay $5.50 in the upcoming season. Still, 2 seasons of below-average milk prices are likely to put pressure on farm bank balances. AgriHQ dairy analyst Susan Kilsby said dairy farmers will be looking to mitigate the impact of low farm gate milk prices by maximising production at minimal cost. Pasture production and the number of cows and milk are the main factors that determine how much milk will be produced. Ms. Kilby said farmers are expected to focus on inputs that will put more milk in the vat. AgriHQ said New Zealand milk output has increased on average 5.5% a year over the past 5 years. Productivity gains accounted for half the growth, while increases in the stocking rate and the area of land used for dairy accounted for the rest. It said gains in per-cow production were achieved through improved pasture management as well as greater use of supplementary feed.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In business news, Eric Watson-controlled Cullen Agricultural Holdings has completed its merger with an American iced tea maker, with the new entity considering raising capital to fund future growth. Cullen Ag entered into an agreement with Long Island Brand Beverages, or LIBB, in January after giving up on a planned dairy farming venture in the US due to a lack of financial support. A new public company, Long Island Iced Tea Corp., has been formed and began trading on June the 1st on the over-the-counter bulletin board, otherwise known as pink sheets in the US. The ownership is split between the former stockholders of Cullen Ag with 37% and members of Lib with 63%. That means Mr. Watson now has a 17.9% stake in the business. The company produces and distributes premium ready-to-make iced tea. Its products are targeted for sale to health-conscious consumers on the go and are sold to a mix of independent mid to large-range distributors who in turn sell to retail outlets. Mr. Watson is not on the board of Long Island Iced Tea Corp, having stepped down as chairman of Cullen Ag in November 2013. The board includes previous Cullen Ag directors Edward Hansen, a former Babcock and Brown director, human rights activist Kerry Kennedy, a daughter of the late US Senator Robert Kennedy, and Richard Roberts, a principal of consulting firm Roberts, Raheb and Gradler. Cullen Ag's former chief executive Paul Vasilakos and Lib's managing director Phil Thomas also sit on the board. Mr. Thomas says, "We're excited to have completed the merger, which we believe allows a differentiated brand and a fast-growing segment of the beverage market to access growth capital efficiently. We continue," he says, "to believe favourable market dynamics and consumer trends combined with Long Island Iced Tea's premium ingredients and strong brand awareness enables us to continue expanding into other markets and potentially new product offerings." Long Island reported net sales of $1.74 million US in 2014. In the 3 months to March 31st, it recorded sales of $262,722 compared to US $174,269 for the previous corresponding period. The company reported a net loss of just under $379,000 for the quarter, which was better than the $565 almost loss the same period last year. Until now, it's been financed through the issue of promissory notes, including US $1.5 million held by Cullen Ag. However, to execute its long-term growth strategy, the company is considering raising additional funds through private equity offerings, debt financing or other means, it said in merger documents filed with the Securities and Exchange Commission. Mr. Watson, who was valued on last year's NBR Rich List at $400 million, has restructured his investment portfolio since the downfall of Hanover Finance, which he co-owned with Mark Hodgson. He's also fallen out with former business partner Sir Owen Glenn, a spat that has resulted in court proceedings in several jurisdictions. Let's talk skills shortages. New Zealand chief executives are more concerned about the effects of a skills shortage on their business than at any other time in more than half a decade. New research from PwC reveals 84% of New Zealand chief executives think a skills shortage is a threat to growth prospects. PwC partner Scott Mitchell says because of this, many companies are turning to part-time employees, contractors, and even outsourcing services to fill the talent gaps. He says the power dynamic between the employer and the worker has been switched and has created a gig economy, whereby a worker with in-demand skills is dictating when, where, how much, and for whom they will work for. He says essentially they're picking which gigs they want to do. Mr. Mitchell says people with strong technology skills who can adapt and work across different industries are desperately needed, but these people are difficult to find and can afford to charge a premium for their skills. He says new places, geographies, and new pools of talent must be looked at, as companies can't afford to recruit people as they've always done. Another problem contributing to this is lack of diversity in companies. He says only a third of businesses have a diversity strategy and are actively working on improving it. He says this narrows the talent pool and makes attracting skilled employees harder. The study also reveals the government has an important role to play in solving the skills gap. More than half of respondents say creating a skilled and adaptable workforce should be a top priority for the government. Finance Minister Bill English told NBR Radio last week simply spending more money on putting students into low-level polytechnic courses does not work. They just end up with debt and no greater employability, so they should either go into work or go into higher-level training which actually equips them for a specific job. He says businesses concerned about skill shortages need to be the ones that find the right people to carry out tasks. The government can get students to the start line, but it's businesses' responsibility to invest in those skills. Mr. English said, "We can't deliver an endless pipeline of cheap, highly skilled people. That's not the government's job. We're no good at it. We don't know exactly what those skills should be, and experience tells you we should be focusing on getting people to the start line."
This is NBR Radio on Wednesday, June 10th. I'm Owen Poland. The equity crowdfunding site Pledge Me has unveiled a rather eclectic mix of companies seeking capital, from a health food company to a sewage plant wastewater treatment system and a soap maker, all seeking money. And joining me to discuss is reporter Calida Smiley. Calida, seems to be a bit of a buzz on Pledge Me at the moment.
Yes, they've now got 5 companies running on the site. Sorbet is the newest one to launch. It launches its campaign, I think, a little later today. And that's a naturally derived hair and skin product company designed by a recent science graduate. There's also Angel Food, which is a health food company, and they do things like milk-free cheese. And they've already raised quite a bit towards their minimum. I think they've, as in the words of the crowdfunders, harnessed their crowd quite well. And then there's also Liquid Waste Treatment Systems, and they're an interesting company, but there doesn't seem to be too much interest in their offer, perhaps because it's not as glamorous as the other two seem.
But where there's muck, there's brass, I guess.
Yes.
Yeah. So is there a common denominator amongst, I mean, they seem all very disparate and different, but what is the common denominator other than they need capital?
I'm not sure if there's a common denominator. I just think they all need capital, and this is the new way to raise capital. The FMA brought in new legislation last year, and Pledge Me and another crowdfunding site, Snowball Effect, got licenses last July.
Now, of course, there are, three now different platforms, equity crowdfunding sites?
Yeah, that's right. There's Snowball Effect, Pledge Me, and Equities. I think Snowball has had 6 successful offers, Pledge Me's had 7 successful offers and 3 failed offers, and Equities has had 2 successful offers.
Okay, and of course the equity raising comes with caveats from the Financial Markets Authority for investors?
Yes, that's right, yeah. The companies raising money on these sites are early stage companies. There are not the same controls that are in place if you're, say, going to list on the NXT market, that's the new stock exchange market, or the New Zealand Stock Exchange. So they're early stage companies, and I think the FMA is just warning, don't get sucked in too much by these prospectuses. They look like they're offering the world, and they have great, huge valuations, some of these companies, but just take a step back and read the prospectuses fully.
Okay, thanks, Kalida.
NBR Radio with Baileys, New Zealand's leading commercial real estate company.
To the banking sector, HSBC Bank is poised to shed approximately a fifth of its jobs internationally as it shifts its focus toward Asia. As many as 50,000 jobs are to be axed over the next 2 years as the bank aims to shrink its annual costs by up to $5 billion by 2017. Operations in Brazil and Turkey are to be sold as well. Asked about potential job cuts to HSBC New Zealand, a spokesman told NBR Radio the company is not able to comment on whether HSBC New Zealand will be affected. He said New Zealand wasn't mentioned at all in the investor update by HSBC yesterday. He says there is no clarity on New Zealand's part in this reshuffle. The spokesman says it's clear in the announcement that Asia is the place for growth in the firm. HSBC Group Chief Executive Stuart Gulliver says the bank plans to develop its business in both the Pearl River Delta in Guangdong Province, China, and in the ASEAN region. He said in a statement, HSBC will expand asset management and insurance in Asia with the aim of capturing expected opportunities from emerging wealth in the region. Some 8,000 jobs will be cut in the UK, and the workforce will be reduced by almost 20% in Europe over the next 2 years. Mr. Gulliver says new strategic action will help the transformation of the bank. This includes a return on equity of greater than 10% by 2017, for Asia to account for more than 40% of risk-weighted assets, and delivering growth above GDP from its international network through investment and foreign exchange. Mr. Gulliver says the world is increasingly connected, with Asia expected to show high growth and become the centre of global trade over the next decade. I am confident, he said, that our actions will allow us to capture expected future growth opportunities and deliver further value to shareholders. In government news, the New Zealand government is still pushing for a shared trans-Tasman tax scheme recognising imputation credits on dividends, which it says is the single biggest step to a closer economic relationship, but is willing to give Australia time to bring it in. In a submission to Australian Prime Minister Tony Abbott's white paper on tax reform, the New Zealand government resumed its push to introduce mutual recognition of the credits, removing the double tax investors currently face on their cash distributions from holdings across the Tasman. At a minimum, New Zealand wants Australia to commit in principle to implementing mutual recognition when it has the fiscal headroom to do so. The New Zealand government submission said in a period where fiscal consolidation may trump wider economy-wide benefits from tax reform, we understand the tax revenue loss may influence decision-making about the timing for implementation of mutual recognition. If Australia is not able to move now to mutual recognition, we seek at least an in-principle decision to implement mutual recognition when fiscal circumstances permit, with CER ministers reviewing the situation at their annual meeting. A 2012 joint review by the two nations' productivity commissions on further linking the neighbouring economies recommended settling the tax credit issue, estimating a shift would deliver economic growth of up to $300 million US a year. That would come at a fiscal cost to the Australian government of Australian $1 billion in foregone annual revenue and $220 million for New Zealand. Australian Treasurer Joe Hockey last month unveiled the federal government's 2015 budget, projecting an underlying cash deficit for the current financial year of 35.1 billion Australian dollars, shrinking to a 6.9 billion shortfall the following year. Australia is forecast to return to surplus in the 2019-20 financial year. The New Zealand government estimates mutual recognition of imputation credits would lift post-tax dividends for investors by almost 39%. Australian investors' effective tax rate on dividends in New Zealand companies is 60.4%, while New Zealand investors face a tax rate of 53%. The New Zealand government said in its submission, "We believe there is scope for Australian and New Zealand officials to consider practical design issues that seek to minimise Australian losses and maximise Australian gains. These could include options such as phasing in mutual recognition. We would welcome further opportunity to discuss these options with Australia." To the dairy industry, Fonterra is to cut hundreds of jobs from support and head office functions as it puts more resources into selling its products overseas. Speaking on Radio New Zealand's 9 to Noon program, Chief Executive Teo Spearing said the dairy co-op needed to trim the sails because the weather is rough. He says, "Do we have to review whether we have too many support functions and possibly not enough people in market? Yes. That's what we're reviewing right now." Mr. Spearing said more people were needed in sales roles, rolling up sleeves in Fonterra's overseas markets, and fewer in support roles. It's a shift of people and capabilities, he said. Asked by 9 to Noon presenter Catherine Ryan how many jobs might go, Mr. Spearing said, "You're talking about hundreds of people more in market, and that means less in group functions." He indicated that an equivalent number of support jobs would be cut in one go, while jobs in sales would be added gradually. The time frame for the restructuring is not clear. A spokesman said the review process was ongoing, so he could not say when any job cuts might take place. Fonterra's Auckland head office is likely to bear the brunt of job losses. The review, due for completion by August 1st, was started last December when it became clear the global dairy market wasn't going to recover as quickly as hoped. The company has slashed its farmgate milk price to $4.40 a kilogram of milk solids for the 2014-15 season and has an opening forecast of $5.25 for next season. An estimated one-third of farmers are likely to post losses this year. Mr. Spearing says volatility in the market means there could be a $1.50 swing either way to the 2015-16 forecast, but he's confident demand will come back in the market at some point given milk inventories are relatively low. There's been anecdotal talk of some of Fonterra's 10,500 suppliers voting with their feet to join other dairy processors offering payouts above Fonterra's rate or not requiring suppliers to pay for shares based on production levels that they will struggle to afford. Mr. Spearing said while some have indicated they will leave the cooperative in the following season, most of those are in regions where other processors have built plants. He says the My Milk brand, where farmers can join as suppliers without having to buy shares immediately, has won at least 20 suppliers back for the next season, and overall supplier numbers have stayed stable. The review includes external input from McKinsey & Co, providing global benchmarking on how Fonterra was performing against its peers, although earlier this week the company refused to confirm the business management consultancy was even involved in the review. Mr. Spearing's rejected criticism that Fonterra had a bloated management structure and its underlying performance had been less than satisfactory, but said the company had to drive harder on the value-add side of the business, despite a 22% increase in the volume of milk that it's had to process in the past few years. It spent $1.6 billion on stainless steel to cope with that influx. The long-term question would be how it would fund investment in that value-add strategy, but the first priority was grabbing more cash, he said. An outline of the top-line plan produced by a team of 15 from around the globe and the senior management team will be discussed with the board next week, and then a bottom-line bankable plan presented to farmers by the start of August.
NBR
With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
In People News, leading barrister Sir Peter Williams QC died last night aged 80 following a long struggle with cancer. Family and friends were with Sir Peter as he died at his Auckland home about 6:30 yesterday evening. He had been knighted for services to law in April in what was described as a moving ceremony brought forward because of his terminal cancer. His wife, Lady Henny Phillips Williams, said at his investiture in April that she was glad the date was brought forward because she was worried about Mr Williams' health. Governor-General Sir Jerry Mataparai praised Sir Peter's commitment and compassion to humanity. He said there are a number of people whom you've represented over a number of years who will be absolutely stoked that they've had a hand or hands in getting you to this momentous point, he said at the investiture. The ceremony took place at Sir Peter's Ponsonby home with guests including Paul Henry, John Banks and Winston Peters. Typically, the night had some fighting words. He said, there are tremendous things to be done, and it makes me angry that I just don't have the strength anymore. Sir Peter was involved in more than 100 murder trials through his career as a barrister. Defendants he represented included Terry Clark, otherwise known as Mr Asia, Arthur Allen Thomas and Bassett Road machine gun murderer Ronald Jorgensen. He was an advocate for penal reform and rehabilitation, pressing his view that prisons make people more criminal. To business hopefuls, a health food company, a sewage plant wastewater treatment system and a soap maker are all raising money on equity crowdfunding site Pledge Me. The newest company to launch is naturally derived hair and skin product maker Sorbet, which opens its offer today to raise between $150,000 and $200,000. Capital raised will be used for marketing and packaging costs, website design and to investigate pushing into Australia and Asia. Founder Brianne West is a recent Canterbury University science graduate whose products are concentrated solid formulas packaged in water-soluble paper. She says in the information memorandum, we're the first beauty company in the world to devote our entire product range to solid products. We aim to be the market leader in solid cosmetics, the Lycra of beauty bars. The company says it's valued at $1.05 million, based on 2.5 times its projected third-year earnings before depreciation, interest and tax. The company, directed by former Macpac chairman Brian Pearson, made a net loss of $5,403 on an income of $116,000 in the 2015 year. Next year, it forecast to make a profit of $41,000 of income of $350,000, and by 2018, it expects to make a profit of almost $290,000 on income of $1.35 million. Plant-based health food company Angel Food is running a campaign to raise between $75,000 and $150,000, with the company valued at $650,000. The campaign has already raised more than $62,000. Angel Food, which supplies its dairy-free cheese to all Hell Pizza stores, 17 South Island New World stores and a Melbourne distributor, will spend funds raised on product development, marketing, new sales channels and export research. It made a net loss of almost $53,000 on revenue of $165-ish in the year 2015 and expects to make $21,000 after-tax profit on sales of $504,000 in 2016, $127,000 after-tax profit on sales of $951,000 in 2017, and $130,000 after-tax profit on sales of $1.35 million in 2018. Hawke's Bay-based Liquid Waste Treatment Systems, which is developing new technology that uses aerobic granular sludge to treat wastewater, hopes to raise between $850,000 and $1.75 million. The company will use funds to finish its research program and market its wastewater treatment plant, which it says would work with local authority wastewater treatment plants and help combat dairy industry waste woes. The technology has lower capital and operating costs than existing systems, with a higher removal of sludge using fewer chemicals, according to business manager Tony Hocking. The company has been successful in its first product trials, but needs to scale up its test reactors to a 75,000-litre capacity, which is the size of a small commercial operation. Liquid Waste, which is valued at $4.05 million and hopes to receive income from selling licenses and royalties, made a net loss of almost $135,000 on revenue of $249 and operating expenses of $108,500 in the 2015 year. It expects to make a net loss of $1.33 million on revenue of almost $216,000 and operating expenses of $1.51 million in 2016, but to become profitable in 2017 with just over $32,000 on revenue of $1.18 million and operating expenses of $1.1 million. It's a busy time for Pledge Me, with these three companies joining two others equity crowdfunding on the site, Powerhouse Wind and Tap a Taxi. The Financial Markets Authority warns it's risky to invest in equity crowdfunding companies by way of their early stage nature.
This is NBR Radio on Wednesday, June 10th. I'm Owen Poland. Well, the Christchurch Council has outlined a positioning paper which has revealed certain assets likely to be on the block, plus a restructuring. And joining me to discuss these developments is Chris Hutching. Chris, tell me more.
Well, it's been going on for a while. This is their long-term community plan. It's a 10-year plan, although it looks initially at the next 3 years in particular, which is when Christchurch's debt levels are going to peak because of all the rebuild infrastructure that we've had to replace due to the earthquakes. Auckland has gone through its own LTCCP process, as it's called, and that was settled a little while ago, but Christchurch is a little bit different because of the quakes and because of the legislation that we're working under, which is the Canterbury Earthquake Recovery Authority legislation, which means that ultimately this plan will be signed off by Sarah, I believe, because there is a specially formed panel that will do that. Anyway, that's the sort of legalisms involved in it, but the basics are the same as everywhere else in the country. We've got citizens groups, community boards, and councillors who want to do a whole lot of things. They want to please their constituents, and of course then the councillors have to go back and say, well, how the hell are we going to afford all this? So Leanne's come up with her own proposal, which is going to be voted on in a couple of weeks' time, so it's not set in stone by any means at this point. Now, she's taken a sort of a midpoint, I suppose, or maybe she's even pulled back a bit more than that, some would argue. Initially, there were a number of people, mainly from the right, that were saying we've got to jettison a lot of city assets. Jerry Brownlow was pushing this idea, and those main assets are the Orion Power Lines Company, the airport, and Littleton Port Company. There are some other assets, though, that were not really discussed all that much, and these are the ones that Leanne is pointing to. One of them is called City Care. It's a infrastructure services company. It does fixes up ditches and roads and things like that. And she thinks that that's probably one that we can look at jettisoning, and there are plenty of companies like that that operate in the private sector. Also, the Red Bus Company is the other one. Plus, she has brought up the prospect of selling a few properties. Do we really need to own things like Lancaster Park, AMI Stadium, and some of the others? Also, there's probably the opportunity to lease buildings for things like libraries. She hasn't quite gone there because as soon as you raise that prospect, a number of folks here in Christchurch start to get very uppity about it, and we've always had a very strong lobby here that's absolutely opposed to selling anything whatsoever. It doesn't matter what it is, and sure enough, we got that reaction from a crowd called Campaign Against Foreign Control in Aotearoa the other day. So Leanne is walking a bit of a tightrope. She's trying to please the people in the east where there was a lot more earthquake damage, but at the same time there are thousands of people that have left the east as well because their land's been red zoned. So, a lot of people are questioning how much should really be spent in the east. Are there really that many people to accommodate anymore? If you spend lots of money on big amenities, saltwater water pools and things like that, is it really going to make too much of a difference to that area? So these are the kind of issues that Christchurch people are looking at over the next week or two, and I'm going to be fascinated to see what sort of arguments we get, especially from the councillors in the east who have been pushing for a number of these amenities, and yet, of course, their constituents are the ones that can really least afford major rates rise increases, which Leanne's proposal would put at 29% over the next 4 years. That's a little bit better than the 33% that was initially proposed, but not a great deal better, in my opinion.
Obviously a lot for the citizens of Christchurch to digest over coming weeks. Chris, thanks very much. That's Chris Hutching in Christchurch.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
Let's talk gas emissions. Major cuts to greenhouse gas emissions would have hardly any impact on New Zealand's economic growth rate, says private economic consultancy Infometrics in analysis for the Ministry for the Environment. The April 13 paper was released to the Green Party under the Official Information Act, but only became available publicly part-way through the government's publication consultation on new climate change targets, which concluded on June 3 and is not highlighted in consultation documents. Infometrics says the impact of reducing non-agricultural greenhouse gas emissions to 40% below 1990 levels, the target currently adopted by the EU, would cost just over 1/10 of 1 percentage point of growth a year between 2021 and 2030, the next so-called commitment period for a globally negotiated new pact to tackle climate change. The Infometrics modelling, which assumes global carbon prices rising to average $50 a tonne, also suggests that there would be little difference between adopting a 40% cut target and a 5% cut. New Zealand is currently offering to cut greenhouse gases by 5% on 1990 levels by 2050, but is to refresh that target ahead of the Global Summit on Climate Change Action scheduled for December in Paris. Some 10,000 submissions were received on the consultation document, which focused on a per-household cost calculated at $1,270 to $1,800 for targeted cuts of 5% and 40% respectively, assuming average household income of $85,000 a year by 2027 and a $50 carbon price. Infometrics says the impact on household incomes from a 10% reduction in emissions over 10 years is not large, at an estimated 1.2%, rising to 1.7% on a 40% target. Looking at national economic output rather than household income, Infometrics projects a 5% greenhouse gas reduction target would reduce gross domestic product by a total of 0.9% over the 10 years between 2021 and 30, while assuming that the New Zealand economy would grow by an average of 2.1% every year during that period. With a 40% cut, the impact over a decade is modelled at 1.1%. The Ministry for the Environment sought the modelling from Infometrics, which warns that its conclusions cannot be regarded as hard forecasts. Infometrics says the results can only ever be indicative. The interpretation should centre on their direction up or down and broad magnitude, small, medium or large, rather than on the precise point estimates that the model produces. The report's release coincides with the announcement overnight from the G7 meeting of the world's 7 largest economies in Berlin that they would support greenhouse gas cuts of between 40 to 70% in 1990 levels by 2050, the first time they've supported a precise long-term target and predicted the end of the use of fossil fuels by the end of the 21st century. Also published this morning are economy-wide recommendations for New Zealand from the Global Rich Countries Club, the Organisation for Economic Cooperation and Development, including that the country should terminate the transitional arrangements in the emissions trading scheme, which exempt trade-exposed industries with large greenhouse gas emissions from dealing with half of their total emissions. The Infometrics report assumes that major emitters account fully for their greenhouse gas output. In technology news, Apple has dropped a strong hint that it's working on an iPad with a larger display. At its Worldwide Developer Conference in San Francisco, the company previewed iOS 9, the next upgrade to the software that runs iPhones and iPads. A key element of iOS 9 is a new split-screen mode that will only work on the iPad Air 2. The new split-screen view lets you see 2 iPads apps side by side, work with either or both, and copy and paste content from one to the other. There will also be a new side overview that lets you select and drag a secondary app onto the screen atop the primary in a 30-70 split without dismissing the latter. Certain Android tablets from Samsung have had a split view for a while now. This is the first time Apple has seriously addressed multitasking apps. It should help an iPad to feel more like a PC. Analysts see the split view option as a sign larger iPads are on the way. Other signature features of iOS 9 include a new low-power mode option for iPhone that Apple says will extend battery life by up to 3 hours by scaling down screen brightness, not constantly polling for new email, and automatically turning off the screen if your iPhone senses its face is down. New power-saving measures will mean simply installing iOS 9 on any iPhone 6 or 6 Plus and will extend battery life by an hour. Apple says faster and smoother performance as well. New features for Siri, including the ability to offer directions based on an invitation and search via voice for photos. The more intelligent Siri will be able to, for example, prompt you it's time to leave for an appointment. and to remind you earlier if traffic is bad, and support for an Apple Pay compatible card reader. That sounds great for small businesses in the US, of course, but in New Zealand there are no plans on the immediate horizon to introduce Apple Pay. iOS 9 will be available as a free upgrade in September. And now an OECD report update. Among other recommendations, the OECD's latest biannual report on New Zealand has advocated the introduction of tolls and user pays congestion charges to alleviate the traffic bottlenecks that respectively earn Auckland and Wellington the title of the second and third most congested cities in Australasia, with Sydney taking the top spot. The economic survey identifies long-term underinvestment in infrastructure as the key cause of the city's congestion woes, and estimates the problem comes at an annual cost to Auckland of $1.25 billion each year in lost productivity. According to the report, placing a cost on travel during peak periods could incentivise drivers to travel at different times if they're not required to be on the roads, or could encourage more carpooling and use of public transportation. It also notes the money raised as a result should be used to fund new roads and increased public transport. Last year, Auckland Council floated the idea of motorway tolls or a regional fuel tax to bridge a $12 billion transport funding gap over the next 3 decades, but in the absence of central government enthusiasm for the proposal, has introduced a targeted rate increase instead.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
In business news, Spark has endured a wave of social media criticism today after it was announced on blog site Whale Oil that the telco was sponsoring an event run by the site's owner Cameron Slater. Spark is playing down its support of a decade of dirt and says it only gifted 2 smartphones with no cash or other support. A Samsung A5 worth $699 is to be given away at tonight's event, which is celebrating Whale Oil's 10th anniversary and will reportedly be emceed by National MP Maurice Williamson after Winston Peters apparently pulled out. A post titled "Sponsored by Spark, Report from the Decade of Dirty Party and Be In to Win a Samsung Galaxy A5" was published on the Whale Oil site this morning along with the Spark logo. It's since been changed to "Provided by Spark, Report from the Decade of Dirty Party and Be In to Win a Samsung Galaxy A5", and the logo removed at the request of the listed company. Spark General Manager Corporate Relations Andrew Puri told NBR Radio, "We did not know they were going to be used in a blog promotion, which has perhaps made our involvement appear more substantial than it is. Love it or hate it, Whale Oil has been part of the New Zealand media landscape for a decade with a large and active readership base." Asked if he thought it was risky to associate Spark with Whale Oil and an event that has no precise description, Mr. Perry says, "We provide support from time to time to a wide range of media outlets and organisations." He adds he's surprised the issue got so much attention. He said, "The fact is we give away a lot of mobile phones on a frequent basis to a range of media outlets, commentators and community groups. That's all part of getting information out there about the technology we offer. In doing so, we don't endorse the editorial policies of any media outlet, including Whale Oil or NBR." Mr. Perry has been described on the site as being a loyal Whale Oil ground crew member, but he says he's only commented twice on the blog, and it was to clarify reader comments. Let's talk super cities, or in fact, not super cities. The Local Government Commission has binned draft proposals for single councils to preside over the Northland and Wellington regions, electing instead to further consult with the area's communities over other options for improving the effectiveness and efficiency of their local bodies. The Commission is, however, forging ahead with a proposal for reorganising Hawke's Bay councils into one super city structure. That's because the Commission's members believe there is community support in Hawke's Bay for such a transformation, whereas there is a distinct lack of enthusiasm among Wellington and Northland residents for that scale of change. Northland Regional Council, or NRC Chairman Bill Shepherd, welcomed the decision, noting his organisation had opposed the Commission's most recent draft proposal in March last year and had been waiting for a new draft since then. The Council's objections had centred on the Commission's emphasis on the use of community boards instead of the NRC's preference for stronger local boards with their own powers and budgets, as well as the lack of options in the draft for Maori representation and decision-making. Meanwhile, the proposal to create a single council from the 9 that currently serve Wellington, Hutt Valley, Porirua, Kapiti and Wairarapa had been rejected by approximately 90% of the 10,000 people who made submissions on it. The Commission has now invited the 9 councils to come up with another local government structure that residents will find more palatable. According to Wellington Mayor Celia Wade-Brown, that structure needs to be much more pragmatic and practical than the super city proposal, which was too ambitious and would have divorced local people too much from the council decision-making process.
This is NBR Radio on Wednesday, June 10th. I'm Owen Poland, and joining me in the studio is reporter Jason Walls, who's been looking into some new research by PwC, which has identified that skills shortages are one of the biggest worries for New Zealand CEOs, Jason.
Yeah, that's right. I mean, it's something that's been quite well documented over the last few years, is that New Zealand has a skills shortage, especially in areas to do with trades and ITs. We see that I've written on this extensively in the last few months, and obviously when you have skills shortages, you get things like you can have a lot of openness to pay increases in those sort of areas. And this report was just looking at it from a different angle, looking at the CEOs, and what it had done is internationally it had surveyed CEOs from around the world and said, are you afraid of where do your fears lie? And they asked a whole bunch of them from around the world. And within New Zealand, over 80% of them said that skills shortage is one of their greatest fears, especially within the New Zealand economy at the moment. So it was very interesting to see that we've heard about it for a while, that we've got this looming skills shortage within New Zealand. It's in fact not looming, and it's actually here today, but to see that New Zealand's chief executives are actually worrying about it too.
Of course, it's a function of the fact that we've got a good growth economy and unemployment is also low.
Absolutely. Unemployment is low. I mean, I will temper that with saying that in the last numbers it did increase by a couple of percent, but however that has been widely regarded is because we have more people coming into New Zealand. Migration is high. We've got more people coming into work, and our labour participation is one of the highest in the world.
This report also highlighted what's being called a gig economy. Tell me about that.
Yeah, well, it's very interesting. So on the surface, you kind of scratch your head a little bit and think, what is a gig economy? How do those two things relate? But essentially what it's conveying is that you've got workers now who have the skills and the means to work. And since they're so in demand, they're essentially a very valuable commodity. So they can now dictate when, where, how, and who they work for and from how much. So there's always been a degree of that, but now it's expanding quite a lot. And you've got this pool of workers that are really being the ones that are driving the demand, essentially.
So these are essentially part-time workers who are moving from job to job to job within a week, within possibly even a day. Yes,
the report mentioned that it was part-time employees. The man that I talked to from PwC, their partner told me that it was contractors, and a lot of the time because they are obviously temporary work for now and then, and you don't have to keep them on. They can move around, so that's giving them the freedom to choose between which employees and which gigs they take. Gigs in the traditional sense being something like a job, like in the musical sense, it's a gig. I'm doing a gig. It's a music show. So it's sort of correlating them with that. And it kind of falls back to this idea. And I hate saying this, but this rock star economy that's been often the buzzword that's thrown around in New Zealand. And it sort of brings it back to that level.
The research also points out that there is a lack of diversity as being an issue.
Yeah, that was something that Mr. Mitchell said to me, and he was saying that I think I wrote there that it was only a third of New Zealand companies are actively working on diversity issues and attracting more people. And he said that although that's good and it's an increasing number, there are still 2/3 of New Zealand companies that don't have any means of doing this, and that's locking a lot of talented individuals out of the employment market.
And just briefly to wrap up, Jason, are there any solutions offered in this research as to how we overcome these issues?
Well, he looked right at the end. They said a lot of the CEOs are looking to the government to say you need to get involved and you need to do something about it. We did have Bill English on NBR Radio a couple of weeks ago who was talking about the government needs to be doing more to get these students in particular to the starting line, and that is having appropriate NCEA qualifications. But when it comes to actually filling the void, that's more up to businesses themselves.
Yeah, fair enough too. Thanks, Jason Walls.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
In market news, Pro10, an Australian chicken farming business whose shares trade on New Zealand's unlisted market, raised 34 million Australian to fund future growth and repay financing. The Sydney-based company exceeded its target detailed last month to raise between 25 to 30 million. The company's shares, which were removed from a trading halt today, last changed hands at 70 cents in April, valuing the company at 70.4 million. Pro10, Australia's largest independent contract grower of broiler chickens for meat, plans to use the funds and bank debt to invest $130 million in increasing production to an annual 72 million chickens from 40 million, taking its share of Australian production to 11% from 7%. It said it may also expand into related protein industries. The company expects to expand its farms in New South Wales and Western Australia, where it has long-term supply contracts with Baiada Poultry, the nation's biggest chicken processor. Pro10 Chief Executive Daniel Bryant said chicken is the most popular meat in Australia and is experiencing the fastest growing consumption rates globally, largely due to chicken's price advantage over other meat. In November, Chairman John Signal said increasing the scale of the company would set the business up for a possible liquidity event in the future. Pro10 is considering floating on the Australian Stock Exchange, the Australian newspaper reported today, citing Mr. Bryant. The company said today some of the equity raised will be used to repay a redeemable preference share financing in 2012. Pro10 raised $9 million from redeemable convertible preference shares in 2012, according to notes from its 2012 annual meeting. In business news, Rangatira lifted annual underlying earnings 15%, helped by an improved second half, and the Wellington-based investment group said it's on the prowl for new acquisitions. It said in a statement operating earnings rose to $9.2 million in the 12 months ended March 31st from $8 million a year earlier, and raised its total dividend to 47 cents a share from 46 in 2014. Net profit sank 65% to $13.7 million, having benefited from a $32.1 million gain a year earlier when it sold its 85% stake in Contract Resources to Halliby Holdings. Rangatira is looking for further investments, saying it prefers middle-market businesses with strong growth potential and prefers to invest as a cornerstone shareholder. Last year, Chairman David Pilkington told shareholders the firm was reviewing its portfolio. Mr. Pilkington said today, "We made the second half gains as a result of a number of initiatives we put in place to deliver for shareholders over the long term. These included making changes to some of our private businesses to improve their operating performance, the appointment of Phil Veal as our new chief executive, and a strategic focus on new investment opportunities to put our cash to work." The company said the asset backing of its shares rose to $11.32 at March 31st from $10.76 at September 30 and $11.20 at the end of its 2014 financial year. Rangatira has two classes of shares that trade on the unlisted platform, with 67% held as Class A shares and 33% in Class B shares to differentiate between charitable and non-charitable shareholders. The Class A shares last traded at $9.50 and the Class B shares at $9.30. In market news, Orion Health, the healthcare system software developer which listed on the NZX last November, says an expected US-based contract has been delayed. Its shares sank to a record low. The Auckland-based company said a contract with one of its US payer customers has been delayed for 12 months because the customer wants to focus on more immediate priorities. But Orion didn't see the need to revise its forecasts for 2016. Orion flagged two contracts with US payers in the lead-up to its IPO last year and has since engaged with other US companies and is expecting to complete contracts by the end of its first half in September. The healthcare management system company said significant opportunities had arisen in other market sectors in major adjacent market areas such as pharmaceuticals and chronic care management. Orion stock is the third worst performer on the benchmark NZX 50 index this year. The company said on January 30 that delays in settling contracts and paying bills in North America would weigh on revenue in the second half of its financial year. North American sales were also dented as it moved customers to subscription contracts from perpetual licenses, it said. The Orion share price fell 5.2% in early trading on the NZX to a record low of $4.20. Having sold in its IPO at $5.70 and stagged on listing to $6.27. The company joined the NZX on November 26 in a $125 million capital raising to assist the 22-year-old company to grow in global markets. Its offer documents gave no prospective forward financial information, and the company told investors that was because recurring revenues currently represent less than one-third of operating revenue, and there is inherent uncertainty about the capture of customer contracts and the timing of their execution and recognition of the associated revenues. It reported an annual loss of $60.8 million in the year ended March 31st from a loss of $1.1 million a year earlier, in line with its strategy to grow revenues before becoming profitable. The company's annual revenues rose 7% to $164.1 million.
NBR Radio. Free to air online with business news you can use.
This is NBR Radio on Wednesday, June 10th. I'm Owen Poland, and welcome to the weekly edition of Foreign Affairs Scope with Nathan Smith. And Nathan, I see the Turkish election results have caught your eye.
Yeah, that was probably the central dynamic of this past week, is the long-awaited latest election in Turkey. Showed a surprising for some, others expected result, but the surprise comes from the loss of majority for the AKP party, the Justice and Development Party, which was Erdogan's party. He was in control for a long time, 13 years, has changed the constitution multiple times, his position multiple times to remain at the top, but it appears that the public have spoken, probably in the direction that he didn't want them to speak, and now he has lost not just the supermajority but the simple majority as well, which means that he can't push a number of the constitutional amendments he was attempting through.
So what didn't the voters like? What didn't they like about the AKP? What changed their hearts?
A couple of reasons. Over the past decade and a half, the Turkish economy has grown substantially. But now that it's stagnating, people are starting to see that maybe a lot of the power that they allotted the AKP isn't actually the direction that they wish to be going in, and they want new economic dynamics. Also, it's a very Islamist party. The Anatolian Peninsula, which is the hinterland of Turkey, is highly Islamic, and Erdogan has tried to pull away from his predecessors Ataturk's secularization of Turkey and make it more Sunni Islamist and try to reach out to those people, and that's not the direction that Turkey, especially in Istanbul, want to go down. They see themselves as being more European. So a number of dynamics, plus his own personal cachet, if you will, is really rubbing people the wrong way. And there's a lot of minority movements, especially in the Kurdish regions in the east, that seem to be pushing different changes. And
I see that the Kurds have actually gathered some support. Yeah.
They managed to get about 10% of the vote, which will push them into having seats for one of the first times. So now they are kingmakers, essentially, for a coalition that will be emerging over the next couple of weeks.
What does this mean in terms of the Turkish government?
It will be probably moving into a period of gridlock now, as you well know, when you bring more people into the pie, decisions can't be made as fast or as robustly as before. So there'll be a lot more discussion going on, but it will mean that Turkey will slow down a lot more when it comes to what it wishes to do in its near abroad, what it wishes to do in its domestic policies, and what it wishes to do for its economy. And there will be more discussion and more voices involved in this, which will mean slow. And so that will change how Turkey interacts with both Europe and the Mesopotamian region.
What about from the outside looking in? How is the world viewing this?
Well, Turkey has evolved from a position of non-interference with others or zero problems with its neighbours, which is sort of held in the last decade and a half, to one of realising that the power that it has, being one of the largest economies in Europe and also the largest standing army in Europe, sort of dictate that it must get involved in its near abroad, especially Syria, and reevaluate its relationships with Israel, for instance, look at what's happening in Cyprus a little bit closely, and how it wants to evolve its relationship with the EU. So the power that Turkey has been disproportional to how much influence it has had in its near abroad, and that will change now as well. The Erdogan's decisions to move will now be more constrained. So the foreign policy aspect of this may actually be altering as well, as we see in the future.
Turning to Iraq, we had this rather staggering admission by President Obama just a day or so ago that he had no complete strategy for that country.
Yeah, it's been obvious for a while that the US has been sort of hands-off as an intervention approach for Iraq. They are trying to encourage the regional powers to take control of this fight. It's, after all, their skin in the game. The Americans pulled out almost completely in 2011. They don't want to get back in. We're not likely to see armoured divisions doing manoeuvres in the Iraqi desert anytime soon, although the estimate has been that 10,000 troops is what they need to fight ISIS. But he doesn't want to get involved. And that's very interesting for for Iraq especially and the region. They're trying to game America to get closer and get back involved, because Saudi Arabia, Iran and Turkey and Israel, to an extent, they don't necessarily see this as being their problem, but it is. So that's the attitude that Obama has taken, and he's publicly saying that now.
Is it true, I heard this, that there are more trainers on the ground in Iraq than there are recruits to train?
Yeah, that seems to be... There's lots of training woes at the moment. I think the US has successfully trained just shy of 9,000 Iraqi troops, but over the past couple of weeks, very few have actually turned up at the doors. It appears that although they want to fight to defend their countries and their tribes, some of them are seeing a lot of battle fatigue at the moment. And especially the problem that they have at the moment is the Americans, when they were fighting in Iraq, they could at least go home on rotation. But the Iraqis can't go home because everywhere is under attack. So when they do go back to their towns, they still feel like they're involved in the fight here, so they can't detach, and that's creating a lot of battle fatigue, and they don't want to go back to the front lines, and it's hurting the coherency of the Iraqi strategy. So it's tough, and the New Zealanders are deeply involved in this as well, and I think the British are sending another 150 odd trainers, which will increase them to about 300 in there. So they're seeing some effect from well-trained Iraqis. But it's harder to encourage more to sort of come in behind now. And so it's just reaching a point of a feedback loop that's quite dangerous.
And how significant is it that the Islamic State forces have taken the Baji refinery?
They did take that a couple of months ago. The Iraqi security forces moved into that region last week and have been some fierce fighting. So this is just north of Tikrit, which a couple of months ago the Iraqi security forces retook as well. So it's just a matter of slowly but surely just pushing ISIS out of key regions. And the Baji oil fields are some of the largest producing oil fields in Iraq. So it's crucial to get that back under Baghdad control.
Okay. You're listening to Foreign Affairs Scope with Nathan Smith. The G7 meeting currently in Europe, what's the key features of that? Yeah,
so a few quick key features is that it used to be called G8, of course, but now it's G7 because Russia is suspended. That's the central dynamic here as well. A lot of the discussion was around what's going on with the Minsk agreement in Ukraine. A lot of the stipulations put forward originally in the Minsk agreement have not yet been organised. There's still a lot of the heavy weaponry that was supposed to be removed. That's still there. The autonomy of the eastern parts of Ukraine still hasn't been organised. So, the Europeans are starting to see a little bit of a stalemate in exactly what they want from this, and it's really up to Putin now to decide what he wants to do. The Americans have pre-positioned troops and armour along a line of countries just west of the Ukraine, so they're saying here and no further. So the ball really is in Putin's court, and he's being more belligerent than we thought he would, and dragging this out probably a lot longer than, again, we thought he would. But looking at it from his perspective, he has some national imperatives here to secure.
And of course, cyber warfare is never far from our minds, and there's been yet another hack on a US military website.
Yeah, it's getting a little bit worse. The Pentagon recently devised its own decisions about what it will do and how it will treat this. They've been slowly evolving from effectively looking at this as a commercial world only, private world, to more of a domain like land, sea, air and space as they do in other places. And so they're starting to treat this more seriously and starting to develop some sort of a hierarchy. But it's so hard to attribute who attacks whom here. And China's involved, Russia's involved, North Korea's involved, South Korea. Most developed countries are involved in this space, but it's still the Wild West. And it was not built for defence. It was built for offence. There's no mountains. There's no sea in cyber. There's nothing stopping you naturally from attacking a system halfway across the planet. And that's what's happening. And a lot of these skills that these groups have are just incredible weapons.
And that's this week's edition of Foreign Affairs Scope. My thanks to Nathan Smith.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
to retail spending figures. New Zealanders spent more on their electronic cards in May as increased retailing of consumable and durable products offset a flat month in hospitality and a decline in apparel. According to Stats New Zealand, the value of core retail spending, which strips out fuel and vehicle-related items, rose 0.4% to $3.9 billion in May, turning around a 0.9% fall in April. On an annual basis, core retail spending on debit and credit cards rose 5% in May compared with the same month a year earlier. Total retail spending, which includes automotive and fuel spending, rose 1.2% last month for an annual rise of 3.2%. The dip in April spending prompted some analysts to reassess the strength of consumer confidence after unexpectedly strong growth through the March quarter. The Crown accounts yesterday for the 10 months through April showed the government's take from GST was more than the Treasury projected in its May 21st government budget forecast. Today's data shows spending on durables rose 0.9% to $1.1 billion in May, snapping April's 1.1% decline, while consumable spending increased 0.6% to $1.7 billion. The gains in the two biggest measures in the index offset flat spending in hospitality, which was unchanged for the second month at $788 million, while electronic card spending on apparel declined for a third month, down 0.8% to $287 million, its lowest monthly level since January. On an annual basis, all four core retail measures rose, with hospitality leading the charge, up 9.2% in May from the same month a year earlier, while durables advanced 4.6%. Spending on electronic cards for consumables increased 4.4% in May from a year earlier, while apparel spending edged up 0.1%. Market news. UK investment house Utilico Investments has continued to reduce its stake in Infratil, raising $7.9 million in an on-market sell-down this month. Utilico sold 2.43 million shares at $3.254 apiece, reducing its shareholding in the Wellington-based investment group to 6.5%. Utilico has a long association with Infratil and is managed by Infratil director Duncan Saville. It began trimming its stake in 2010 when it owned almost a fifth of the company. In January, Utilico sold 10.4 million Infratil shares at $2.95 apiece, with most bought by the Accident Compensation Corp's investment arm, which now owns 11.3% of the company. Infratil shares rose 0.2% to $3.235 and have climbed 117% in the past 5 years. The stock is rated a hold based on the consensus of 6 analysts polled by Reuters. In market news, the chairman of listed food and beverage investor Veritas Investments is stepping down less than 2 weeks after the company downgraded its profit guidance by $1 million. Veritas chairman Mark Darrow, who's been involved with the company for 4 years and was a founding director, says in an NZX statement he will step down at the end of this month. Director Tim Cook has been appointed acting chairman while a review of the board is considered. Mr Darrow says several private business projects need his time and attention, meaning he's not in a position to chair the company. He said after a busy 4 years, this is an opportune time to stand aside. This has been a demanding but rewarding role as the group successfully completed 4 acquisition projects from a standing start and in a relatively short period of time. At the end of last month, the company said its net profit after tax for the year ending June 30 will likely be $4.3 million, down from the $5.3 million guidance given in its half-year results. At the company's annual meeting in November last year, guidance for net profit after tax was given as being between 5.3 and 5.8 million. Shares in the company have fallen 59 cents from late January to 73 cents a share shortly following the announcement. The share price had fallen to 68 cents before Mr Darrow's resignation. Mr Darrow said, "I remain an enthusiastic, supportive and acquiring shareholder and see full year 2016 as the year the Veritas Group shows the potential it has through the performance of the 4 business units after the recent settling-in period." Veritas says the key determinants of the full-year result will be the speed of improvements at Nosh, the performance of its Better Bar Company sites in Hamilton, and the impact of the new drink driving legislation. It says the Mad Butcher business continues to trade to expectations, while the Kiwi Pacific Foods joint venture is trading strongly. Veritas says Nosh's turnaround is progressing well, but is behind schedule.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To the dairy industry. The uncertain future of the dairy industry, seen as a bellwether for New Zealand's primary sector and wider economy, is concerning many sector leaders, according to KPMG's 6th Agribusiness Agenda Survey. KPMG Global Head of Agribusiness Ian Proudfoot said conversations about dairy have changed dramatically from a year ago when milk prices were at an all-time high and people thought price setting on the international market would be less volatile. He said, but the market is as volatile as it ever was. When prices are strong, you get a competitive reaction with the US responding, China recovering from biosecurity issues and positioning itself to have a stronger domestic sector, and changes in Europe with the Russian restrictions and lifting of quotas. The Ministry of Primary Industries Situation Outlook for Primary Industries this week forecast dairy export revenues would fall 22% to $14.2 billion in the year ending June 30. Then improve by a compound annual growth rate of 6.8% over the next 4 years, particularly from 2017. Mr. Proudfoot says, but the scale of the milk price decline has shaken people's belief that there had been a step change in commodity prices due to increased demand, and the key learning was that New Zealand's primary sector doesn't have an exclusive right to sell its products in any market at a premium. He said there's huge opportunity to receive value from the product we produce. We can't do what everyone else does. We have to do it differently and have to have the right people and investment. KPMG estimates the average value return to the farm gate is between 10 to 30% of the final retail value of the product, with a return for many key sectors lying toward the lower end of the range. Mr. Proudfoot said the obvious question is why companies continue to invest heavily in processing assets when it's increasingly apparent that realising significant value requires bold investments that enable companies to get closer to their ultimate customer. He points to the kiwifruit sector where Zespri, through innovation, has secured prices for kiwifruit that are double its competitors' returns. For the 5th year in a row, improving biosecurity was the key priority of the 104 primary sector leaders surveyed. Those surveyed said the cost of Auckland's fruit fly response was likely to be many times the incremental cost of funding full border screening. The government has said it will introduce a specific international passenger border levy to fund a $27 million additional investment in border biosecurity, and it's also updating the 2003 biosecurity strategy. Mr. Proudfoot said he supports both moves, but doesn't think they go far enough. Another high priority for industry leaders was delivery of rural broadband. While those surveyed acknowledged it would never be economic to build rural broadband from a purely commercial perspective, they argued there was a public good element. The report said, unlike urban areas where the rollout of ultra-fast broadband was largely supporting entertainment, in rural areas it has the ability to improve productivity, attract people to work in rural communities, and deliver better health and education services. In local government news, Auckland Council has declined the Chamber of Commerce's request for an independent investigation into claims the council-owned Regional Facilities Auckland, or RFA, is undercutting private companies and monopolising the city's events business. Chamber Chief Executive Michael Barnett says Council Chief Executive Stephen Town told him the Council has no intention of holding any inquiry and a more professional approach should have been made. Mr. Barnett says we are a professional organisation, so I'm not entirely sure what he means by that. 40 businesses making complaints over RFA's tactics can't all be wrong or unprofessional. Mr. Barnett has instead been referred to RFA Chief Executive Chris Brooks for a meeting at the end of the month over the issues. Before joining RFA, Mr. Brooks was Chief Executive of Melbourne's Federation Square. Mr. Barnett wants RFA to make progress on answering the Chamber's concerns before the meeting. The business's main complaints are over RFA undercutting existing suppliers with $12 million of its own equipment, subsidised by ratepayers' funds, and hired out to its own venues at 30 to 50% below market rates. There are also concerns over the appointment of Australian-based spotless brand Epicure as the only caterer supplying services at RFA's taxpayer-funded venues, and the proliferation of backroom loss-making deals to beat off the competition. Mr. Barnett says if private companies operated like this, they would run at a loss and be out of business. Construction industry operator and NBR reader Bruce Haycock says as break-even is on the basis of covering expenses, it would be interesting to know whether RFA's costs are comparative with private sector outlays. If they are, in fact, indulgent costs, as is common in any effective monopoly situation, then only breaking even shows pricing at below market rates, which lends support to Mr. Barnett's criticism. He says the reality is that council and government trading entities can justify their existence forever and a day, including appeals to their social dividend. He says the only way to prove validity or customer value of their existence is through the funder-provider split. Support for the Chamber's stand has come from another source too. The Auckland Ratepayers Alliance, part of the Taxpayers Union, says the council should not be in the business of using ratepayers' money to chase rate-paying businesses out of the market and in the process destroying private sector jobs. In a detailed response to Property Investor over the Chamber's claims, RFA External Relations Director Paul Brewer says RFA is required by the council to operate as a sustainable business, utilising sound business practice and commercial acumen to ensure Aucklanders receive value of their investment. He says RFA doesn't rent venues on a space-only basis, as this is not the model that was set up when the organisation was created. He says to complement our venues, we provide a full range of ancillary services. Provision of these services, as well as close monitoring of our suppliers' service levels, ensure Auckland can meet the expectations of international clients.
This is NBR Radio on Wednesday, June 10th. I'm Owen Poland. The Eric Watson-controlled Cullen Agricultural Holdings has completed its merger with an American iced tea maker, with the new entity now considering raising capital to fund future growth. Joining me in the studio to discuss is Duncan Bridgman. Duncan, obviously this has taken a little while to come to fruition.
Yeah, they did announce in January that this deal was going ahead, and last week they consummated that merger, and it's basically between Cullen Agricultural Holdings Corp, as you mentioned, which is about 49% owned by Mr. Watson, and a US company called Long Island Iced Tea. Now, the merger went ahead last week, and the new business, which is Long Island Iced Tea Corp, is now trading on the over-the-counter market in the States.
Now, this is not the Long Island iced tea that we all know is the famous cocktail, is it? This is what maybe a health drink or something like that, is it?
Yeah, they're certainly talking it up as being a sort of a quality, ready-to-drink, non-alcoholic beverage, and there's various products they've got. There could be raspberry flavours, different flavours, and they're saying that it's going to appeal to the sort of on-the-go consumer who wants to pick up a beverage on the way, and they're quite established in and around New York, New Jersey, so they've got a base. They just need some capital.
This is a fairly radical departure for Eric Watson. I mean, from a proposed dairy farming venture in the US to selling iced tea. Does this signal a failure of his dairy ambitions in the States?
Well, there's mixed signals on that. Definitely Cullen Agricultural had hoped to get involved in the dairy farming sector in the US, and they had a number of farms, quite a few hectares under their belt. They couldn't sort of attract, they couldn't attract some finance to really get that going, so they offloaded the farms. But I do understand that Mr. Watson is still involved in dairy farming in the US along with his brother Richard. So he still has large amounts of assets in the dairy sector up there. It's just not part of this group. So now he's getting into a different field.
Now, the Long Island Iced Tea Corporation had started trading at the beginning of the month in the over-the-counter bulletin board, otherwise known as pink sheets. Tell me more about that market.
Yeah, well, I guess it's a less regulated market than the ones that we're all familiar with, such as the Dow and the Nasdaq and that. But it's a vehicle, I guess, or a platform for growth companies that don't want to be burdened with the high regulatory regime that's the norm, and it's a low cost area. It doesn't have the greatest reputation, and there's various penny stocks, as they're called, that have become notorious over the years. But there's still an amount of quite promising companies that do list on there, and so it's another platform for companies to access capital with.
Now, see, Eric Watson will have a 17.9% stake in the new business, and it reported net sales last year of $1.74 million. So it's actually, quite small at the moment, but they're looking to raise some capital.
Well, I think so. They do say that in the supporting documents for the merger, and although there's no guarantee that will happen, it is just a small company and something that, if they're going to execute their growth plans, it will need possibly to raise some equity or some debt offerings. At the moment, to date, they've been relying on what's called promissory notes or loans from the likes of Cullen Group, and but going forward, they really want to probably get some more liquid capital in the business. One
thing we can say about Eric Watson Duncan is he's never dull.
Yeah, that's for sure, Owen. You got that right.
Yeah, cheers.
NBR Radio with the Property Press. It's out now to show you around.
So let's talk about New Zealand. Rapid population growth and burdensome planning rules are pushing up the cost of houses, increasing inequality and restricting economic growth, according to the OECD. In the global think tank's latest biannual report on New Zealand, the housing situation is highlighted as one of the main causes of concern, along with low savings rates, income inequality and environmental issues. The report notes New Zealand has enjoyed unusually strong economic growth in recent years, but that bottlenecks in housing, urban infrastructure and skills, inequalities in living standards and rising environmental pressures all pose risks for sustaining growth. The report says rapid population growth and a low responsiveness of supply have led to housing and urban infrastructure constraints. In particular, it says house prices have risen sharply in Auckland, the largest city, eroding affordability and raising financial stability risks. Efforts to speed the housing supply response have been made, although community resistance to rezoning and densification may limit development. Environmental regulations also appear to be relatively burdensome for economic activity, including for residential investment. Finally, the foreign debt position, which reflects low private saving, has been large for some time and is an ongoing vulnerability. The report's author, economist David Carey, says despite some claims to the contrary, New Zealanders are not putting too much of their money into housing. He told NBR Radio, in terms of physical investment, it's difficult to argue New Zealand is over-investing in housing given the high population growth. He said it's clearly the case there are housing shortages in Auckland and the supply is not keeping pace. But there is a need for a greater level of savings going into investments other than housing, he says. As for housing itself, the report is damning about the effect of restrictive planning rules in making houses less affordable and the contribution of this to growing inequality. It says the price responsiveness of housing supply in New Zealand may be lower than in best performing countries due to the time it takes to deliver building sites and complete dwellings. The responsiveness of supply depends not only on geography and urban characteristics, but also on land use regulations and planning restrictions. These regulations may have been increasingly binding in Auckland, where the soon-to-be expanded metropolitan urban limits have been a constraint on supply. It went on. This has been reflected in land prices in and near Auckland, which have grown faster than in other regions and account for roughly 60% of the price of a home relative to 48% elsewhere, and may have contributed to increasing further the already high number of people per dwelling relative to other regions. The study highlights the way the Resource Management Act is used, saying it's highly devolved to local council level, and this has led to both unnecessary duplication of red tape at local level, as well as enabling capture by vested interests. While regulations are essential to ensure that externalities, such as those impacting the environment, are properly taken into account, designing and implementing them in a way that is most friendly to competition and entry is crucial to minimise the economic burden, which in general is relatively high in New Zealand.
This is NBR Radio on Wednesday, 10th of June. I'm Owen Poland. And joining me in the studio is reporter Jason Walls, who's been looking into an announcement from HSBC about a massive global restructuring, Jason.
Yeah, that's right. It works out to be about a fifth of their global staff over the course of the next 2 years. So what they're doing is they're taking a more intense look at Asia, and they're looking to refocus into that region. They've got a lot of different ideas that they're going into the region, as I've reported a couple of times before. Growth within Asia, especially the middle class of China, within the next 10 years is going to be the big economic story around the world. So they're really looking to utilize this and get involved in the early stages. Well, I say the early stages. It's been going on for a while, but as it sort of develops. However, at the same time, they've been looking within their own company and decided that they're potentially their focus so much in Europe right now isn't exactly what they're looking for. And you can see in the story that 8,000 jobs in the UK are going to be hit. So it's a European-based bank, and so it's going to be it's going to not be great for them in the UK, and we've seen that also Brazil and Turkey are going to be taking a hit as well.
Yeah. So they're actually moving the headquarters, as I understand it, of their wealth asset management business from London back to Hong Kong. How much of this is about the damaged reputation for HSBC arising out of that Swiss banking scandal, do you think?
Well, it's unknown at this stage. I mean, in the release it didn't say anything about this, but you'd have to think in the back of the mind after a huge scandal like that, that there'd be big implications, and it could be when they were hit by this, they got a lot of fines, as you'll know, and we've talked about it before. And you did rightly point out one time when we were off air, I think, it's probably pocket change to them. But at the end of the day, if it's their reputation that's been taking a hit, isn't it? And so potentially this could be around that idea as well. But, I mean, we've seen that HSBC have sort of been losing a little bit of momentum within the past couple of years as well. So it's probably a step in towards looking in a new direction.
Yeah, because, I mean, their profitability has been relatively flat. Their targets haven't been met. So in a way, I mean, they're downsizing. Essentially,
yeah. I mean, that's what you would call 50,000 jobs to be axed. I mean, they had a job base of about 260,000, I think it was. So this is about a fifth of their employees over the next 2 years. So it's definitely downsizing, quite big downsizing as well.
Now, what impact, if any, is that going to have on their operation in New Zealand, which has been relatively low profile, I think?
Yeah, well, we're not sure at this point. I contacted somebody from HSBC, and the spokesperson told me that at this stage there's been no mention of what's going to be happening in New Zealand. So from his comments, all I can assume is that we don't know yet, or if there is something, it's being kept under wraps at this point in time.
And of course, what also came out, I think, is they're looking, as you say, at offloading their Turkish and perhaps their Brazilian operations. And it seems the Brazilian business in particular, I mean, they were just investing huge amounts of money and making virtually nothing.
Yeah, it seems that way. And they did say within the media release that they're going to keep a few of the key clients on in Brazil. But I can only assume that means that they're working from overseas as well, which, I mean, if you're a big client in Brazil, you'd probably see something like this and have the potential to think, ooh, might actually back away. So it will end up backfiring in that region, I would think.
Okay, well, we'll watch developments with interest. Thanks. That's Jason Walls.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In development and motor racing news, racing car enthusiast and millionaire track investor Tony Quinn has formally announced his plans for Hampton Downs Motorsport Park. The deal was reported exclusively by NBR last month. He has development plans scheduled for the next 16 months that he says will complement his other motorsport venue in central Otago, Highlands Motorsport Park. Mr Quinn has confirmed settlement of purchase of the Hampton Downs North Waikato racetrack at Te Kaupata and its surrounding 150 hectares. He will relaunch Hamptons with an international event in November 2016. Hamptons Managing Director Tony Roberts, Operations Manager Gary Sterling and Business and Marketing Manager Claire Gullidge will remain in their existing roles for at least 6 months. Mr Quinn has asked them to provide a priority list of things to do at the park. He intends to have tender documents produced fairly quickly for the bigger projects, such as the construction of corporate suites and a control tower above the pit lane garages, a go-kart track, a second skid pan and a track extension which will add 1 kilometre to the existing 2.8k layout, so quotes can be obtained and contracts issued over the winter for work to start in spring. He says 4 or 5 different projects can be undertaken by different contractors at the same time without affecting the day-to-day track operation. He said there will be a flurry of activity when spring sets in, and I expect a fair bit of finished work by Christmas and into early New Year. Mr Quinn says he wants people to be clear that Highlands in Otago is a totally separate business model from Hamptons. Highlands is a tourist venue that caters to tourists year-round with a small number of high-profile motorsport events each year. Hampton Downs is an absolute flat-out racetrack. It is used 330 days of the year for racing, corporate days, testing and the like, which will continue. He says nothing's going to change. Anyone that's got a booking now, that's fine. All the projects we're doing are outside the normal day-to-day operation of the track, but people will start to see the new facilities being completed and used as we head into next year, and the GT extravaganza we have planned as the park's relaunch in November 2016. Mr. Quinn says he wants to complete Hampton Downs the way it was originally intended, to create a world-class motorsport park that complements Highlands. He said in about 16 months' time it's going to be a truly fantastic facility to visit, and there is no doubt that Hampton Downs and Highlands are going to be the two best tracks in New Zealand. If we have any international categories here, it would be sensible to expose them to fans at both Hampton and Highlands. He says already we've told our Highlands members that they are most welcome to use Hampton Downs as one of their membership privileges, and we will also introduce memberships at Hampton Downs that will give members certain privileges, including access to a pretty fancy members' lounge where members and their partners can mix and mingle and enjoy the premier status of being a member. He said we want to listen to people's suggestions for Hampton Downs. So what we're saying to people and to staff, tell us what you think would be a good idea, what would work. If it's practical and doable, we'll do it.
This is NBR Radio on Wednesday, 10th of June. I'm Owen Poland, and joining me in the studio is Tim Hunter, who's been looking into this surprise announcement from Fonterra's Chief Executive, Teo Spearings, today that several hundred management jobs are on the line, Tim.
Yes, so it seems. Teo Spearings was being interviewed on Radio New Zealand this morning, and he indicated that a management review that's ongoing at the moment is considering, I guess you could call it a reallocation of staff resources, which involves increasing the number of salespeople and marketing people they've got selling their products overseas, and correspondingly reducing the number of people they have at head office and in support functions. And those numbers he seems to be indicating, they could be in the hundreds. With the job losses coming before the job increases.
They're just building a flash new headquarters in downtown Auckland. They might have a few vacant spots there, Tim.
I'm sure it's all perfectly planned, yeah. I think, I remember at the time of the interim result, they did use language that indicated at least the potential for some job cuts. That was my interpretation anyway. And obviously these things do take a bit of time to be considered. But I don't think even Teo Spearings' own PR team really knew that he was going to be announcing effectively that move today.
Fundamentally and philosophically, does this signal a shift in thinking at Fonterra about them being simply a commodity producer?
I'm not sure that it does. Fonterra is a complicated beast, and obviously we're very interested in it because it's so influential on the New Zealand economy. But realistically, we've got to remember that Fonterra is a cooperative, and as a cooperative, its core function is to respond to the interests of its owners, who are farmers and dairy farmers, and they require the cooperative to act as the primary buyer of the milk that they produce. So Fonterra has a duty to first and foremost buy that milk and process it and ensure that it can be sold. It doesn't really make sense to think of Fonterra as a Nestle. It has a completely different background and really and should continue to have that background.
But by the same token, Mr. Spearings has indicated that they want a bigger marketing push, and he's also indicated that they want a more drive into added value.
That's right. It's certainly always been part of the Fonterra strategy in recent years to increase their value added, and they do have a substantial value added element depending on how you define it. I think this particular move is perhaps a response to the current market where we see lower prices for internationally traded dairy products, which is obviously affecting Fonterra's returns to farmers. So they need to adjust their business approach to respond to those market considerations. But this particular, news, I don't think is any sign that they're changing tack at all.
Maybe they're also getting a few signals from their perhaps increasingly concern farmer shareholders, about profitability and also about the fact that historically Fonterra has had a lot of very well-paid executives, Tim. I remember a few years back they had 2,500 employees earning more than $100,000.
Yes, that's right. It's it's a very big business. We got to remember it's one of our biggest businesses, and yes, farmers can look askance at that quite easily. It's natural that farmers will be very concerned at these lower returns that are heading their way from Fonterra's production. But I think that it's a two-way street. I think farmers, to some extent, have taken on too much debt and been too prone to see those high prices that we've seen in recent years as being a new normal. It's a commodity business, and commodities do go up and down.
Well, we'll watch the outcome of this Fonterra review with great interest. Thanks very much, Tim Hunter.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.